Hello, my name is Stephen Papacek, and today we'll be talking about credit union regulation. In addition to presenting material regarding credit union regulations and who has authority to govern credit unions, I'd like to present a viewpoint of how credit unions really compare to banks on a couple of different topics, primarily in the financial management and performance. So before we jump into regulation, I think it's important to level set on some basic understandings for what a credit union is, the difference between banks and credit unions, some demographic information to understand from a market perspective, such as size of assets, and then we'll get into some of the regulation discussion. I will mention some notable regulations and laws that credit unions must comply with, which are very similar to the banking industry in terms of consumer protection as employers. And then we'll briefly discuss the financial crisis and the financial performance of banks versus the credit unions and the regulation resulting from the crisis. I will close with the post-financial regulation and the impacts on the credit unions, as I believe it sets a good framework for an argument of regulation versus deregulation. So what is a credit union? A credit union establishment dates back to 1864 in southern Germany. It started by a gentleman named Frederick Raveson. It isn't until 1909 until they find their way into the U.S. by a gentleman named Alfonso Desjardins. In 1934, President Eleanor Roosevelt signed the Federal Credit Union Act, and this is known as Roosevelt's Law, in which the purpose of the credit union is to create a system of not-for-profit cooperatives that promote thrift and sound financial practices. A credit union is a nonprofit cooperative, as stated, financial institution, which is owned by its members. They have a volunteer board that runs each credit union, and it's elected by its members. So really, in terms of the purpose, there's really a strong tradition for searching for better ways to understand and serve the credit union members. It's truly a democratic process in which open dialogue, debate, and free flow ideas occur, and really it's meant to benefit its members. They offer the same services as banks, such as checking accounts, savings accounts, personal loans, and more. Credit unions require membership, however, and this is typically, as mentioned, based on a place of employment, worship, or associations, to name a few. Federally chartered and federally insured state credit unions are insured just as banks are, up to $250,000, and they're backed by the U.S. government. This resulted from President Obama signing the Dodd-Frank Act into law. So let's talk a moment about the basic differences between banks and credit unions. While banks and credit unions are both financial institutions that offer similar services, banks are for-profit institutions and credit unions are not for-profit institutions. A clear distinction between the two. The customers of a credit union are its members, as I previously mentioned, and they own the institution. Whereas the bank is a company, and like most companies, they're seeking to maximize profits for its stockholders. The profit for the credit unions, however, is returned back to members versus stockholders in the form of better rates, lower fees on their deposit accounts. Credit unions also typically tend to provide localized personal customer service, and while banks can offer typically more innovative products and up-to-date technology. So let's move on to some demographic information. So here's some information I provided that really puts some context to the size of the market share, really from a bank's perspective and a credit union perspective. Figure 1 shows percent of market share broken down by large and small banks, and credit unions. The large banks have 74% of the total market share, small banks around 19%, credit unions with smaller gains of around 7%. Figure 2 similarly shows kind of this total market share, but in terms of assets, really no comparison in terms of banks and credit unions. The banks really dominate in terms of total assets. Also, it appears banks have grown at almost an exponential rate versus that of credit unions. And in figure 3, we have a number of new bank charters versus credit union charters, which further displays really a disparity between the banks and the credit unions in terms of growth. So I think this information provides a good understanding of the economic and financial impact of these two financial entities. It also sets the stage for discussion on regulation. Regulation is needed to protect society at large, I understand, but should all organizations be required to comply with the same regulation? Credit unions are a small part of the financial pie with financial impacts or to the financial system as shown in these graphs. So let's talk a little bit about regulation now. The Federal Credit Union Act, signed into law in 1934, really establishes the National Credit Union Administration as the governing authority over credit unions. The Act provides and explains the requirements for federally insured credit unions and the scope of the NCUA's authority over them. Requirements consist of basic structure of federal credit unions, such as their chartering, their memberships, loan and investment powers, and their credit union directors must really reference this FUCA prior to making decisions regarding a particular investment or change in credit union lending policy to ensure it's permissible. In addition, the Act really outlines the additional regulatory structures in which the NCSU has authority over, such as the National Credit Union Share Insurance Fund. Just like the FDIC insures deposits in banks, the NCSUIF is backed by the government and insures deposits in credit unions up to a total of $250,000 in individual accounts. We discussed requirements of membership previously for credit unions, in which members must have, a common bond, such as their place of employment, as an example. This changed in 1982 when the NCUA passed a policy in which multiple groups could obtain membership. As a result of this NCUA policy, a legal case pursued between NCUA and the First National Bank and Trust, and ultimately ruled by the Supreme Court, in which the NCUA policy was reversed and resulted in the Credit Union Membership Access Act. This act was passed in 1998, which amended the Federal Credit Union Act and requires members to have one common bond to obtain membership in the credit union. Excuse me. In addition to the NCUA as the governing authority, most states have their own credit union laws for state-chartered credit unions. This creates a dual structure for chartering, regulatory oversight for credit unions. And most credit unions are federally insured. Only a small portion of the population of state-chartered credit unions maintain any private insurance coverage. Each state regulator administers a body of laws and regulations similar to federal standards. These rules apply to credit unions chartered under the state's authority. A law similar to the Federal Credit Union Act establishes the foundation for chartering, organizing, operating, and supervising credit unions in each state. In terms of credit unions as employers and consumer protection, credit unions must comply with the same laws as banks. I'm going to outline some of the more notable laws which depository financial institutions must comply with. The first being Equal Credit Opportunity Act. This was enacted in 1974 and makes it unlawful for any creditor to discriminate against anyone on the basis of race, color, religion, national origin, marital status, age, or gender. The Truth in Lending Act. This law was passed in 1968. And this is to ensure all consumers are treated fairly from the financial lending business. It requires lending businesses to provide the true cost of credit by disclosing all fees and charges associated with a loan. Next, we have the Home Mortgage Disclosure Act. This was enacted in 1975. The law states and requires lenders to disclose information regarding applicant and borrower characteristics on which they can identify and prevent discriminatory lending practices. The Fair Housing Act. This was a law that was passed in 1988, and it amended Title VIII of the Civil Rights Act of 1968, which prohibits discrimination based on race, sex, color, religion, or national origin for home rental, sales, and financing. The Equal Employment Opportunities in terms of civil rights. This is the U.S. Equal Employment Opportunity Commission. They were in place to enforce federal law, these types of federal laws, prohibiting workplace and discrimination. And under Title VII of the Civil Rights Act of 1964 states that it prohibits discrimination by employers based on race, color, national origin, sex, and religion. It also prohibits employers from retaliating against any employee who exercises this right. Next, we have the American with Disabilities Act. This prohibits employers from discriminating against persons with disabilities who are otherwise qualified for employment and requires employers to make reasonable accommodations to these known disabilities. And finally, we'll touch on the minimum wage and overtime rules. This is an act that was established and entitled the Fair Labor Standards Act of 1938, and it establishes the minimal permissible wage per hour and the maximum number of hours above which an employer must pay an employee overtime. So, these are just a few notable laws in which depository and lending institutions must comply with. There are many others. The emphasis is that, like banks, credit unions have similar laws that regulate them. So let's talk a little bit about the recent financial crisis, in which consisted of poor lending practices, specifically with high-risk loans known as subprime mortgages. This had a significant contribution to the economic downturn that led the U.S. into the worst recession since the Great Depression. Banks played a large role by pushing subprime mortgages, which escalated to historic highs, reaching 23.5% of all mortgage originations through the 2007-2009 time period. The lower credit quality of these subprime loans ultimately caused massive defaults and is considered a proximate cause for the financial crisis. So a few graphs to share. Graph 1 illustrates the number of failures in terms of banks versus credit unions during this time frame. By far, banks consistently had higher failures. Graph 2 illustrates the net number of loan charge-offs. Again, banks having a more significant impact. Figure 3 represents historic unemployment rates as an economic stressor, which again illustrates banks' vulnerability to manage effectively in terms of loan delinquency rates. And the fourth graph shows loan delinquencies in total for banks versus credit unions. Again, banks leading the way. This information reveals that through good and bad economic cycles and stress, credit unions are better managed and financially responsible. As a result of the financial crisis, increased regulation was needed to protect society as a whole. However, my question is, should additional regulation be required for well-managed businesses who did not contribute to the financial crisis? So the resulting regulation, known as Dodd-Frank Wall Street Reform and Consumer Protection Act, was signed into law by President Obama in 2010. This was directly in response, for the need to better regulation and transparency of the financial business sector. Although the regulation can be argued as needed, it has had a major negative impact on credit unions in terms of cost. Should credit unions be regulated differently than banks? That's really my question. Credit unions are less sensitive to the business cycle than banks. As David Smith, who is a professor at MSU, described, both are impacted when unemployment rises, but the trajectory and magnitude of delinquencies and charge-offs of banks, especially during the latest downturn, both are impacted. And they're much more pronounced in terms of banks because credit unions appear to be about 75% as sensitive to macroeconomic shocks as banks. Regulators should consider imposing lower capital requirements to account for the lower risk. Credit unions in general seem to have retained conservative portfolio strategies. I want to talk a minute about really the effects of the Dodd-Frank on the credit unions. Credit unions have seen the average number of full-time employees devoted to compliance work increase tremendously, at least 75% since the passage of Dodd-Frank in 2010. As expressed by the National Association of Federally Insured Credit Unions, total compliance expenses have grown by an estimated 59% since Dodd-Frank, and they're expected to grow by 86% over the next 3 years. Mortgage regulations led to the greatest increase in expenses since Dodd-Frank, as respondents reported, a 200% increase in estimated cost. It's incredible. So the question, should credit unions be held to the same regulation as banks? Should they get regulation relief? As when President Roosevelt signed the Federal Credit Union Act into law, stating its purpose as to create a system of not-for-profit cooperatives that promote thrift and sound financial practices, credit unions have lived up to its purpose. That concludes my slideshow. Thanks for watching.